Welcome to the course Forex Basics. In this first lecture, we are going to learn the vocabulary. Once we understand the terminology, we can better understand the basic instructions for getting started in the Forex market. But first, a warning. You can lose money in the Forex market, and you can lose money fast. The most important part of this entire series of lectures will be how to control risk. The channel cannot teach you strategy. You will need to decide which method or platform you will use in your trading. We will use eToro for learning purposes. What are capital markets? Capital markets are where buyers and sellers exchange cash, or capital, in return for ownership rights of an asset. They can trade or invest in financial instruments ranging from stocks to crypto assets in the hope of generating a return. What is volatility? Measure of risk. Volatility measures how much a security's price changes over time, reflecting its risk and uncertainty. Another word for volatility is unpredictability. Going long or going short. Going long could be referred to as a buy position. Going short could be referred to as a sell position, or going to a sell position. These two terms will become easier to understand with time. What is a stop loss? A stop loss is an order you place with your broker to buy or sell an asset you are holding when its price reaches a certain level. Stop losses are used to limit losses and manage risk, even if you are not actively monitoring your account. Therefore, you can control your losses when you know what you are doing. Your homework assignment is to open a dummy account with a Forex platform. You more than likely will need to provide documents to prove your identity. If you would rather not trade currencies, but want to understand the basics, you are in the right series of lecturers. You are not taxed on your initial investments. You are taxed once there is a taxable event, such as making a trade. Regardless if your trade results in a loss or a gain, the information is needed for your US taxes. It does not matter which currency pairs you are using in your trades. You must document the date of the trade, the initial investment, the date of the sell, and the ending result, regardless of a gain or a loss.